Hello everyone and welcome to the presentation of Group 30. Today we're going to talk about the merger of Vodafone AirTouch and Mannesmann. By analyzing the case of Vodafone AirTouch and Mannesmann, we could identify three strategies used. Firstly and most foremost, it was an M&A as it was a hostile takeover made by Vodafone intending to acquire Mannesmann. Then it was also a diversification strategy because both companies were prominent in the same industry. However, while Vodafone was primarily focused on mobile telecommunication, Mannesmann had a slightly more diverse portfolio. Lastly, it was also a horizontal integration as it integrated both companies' operations across various markets. Now let's look at the decision quality by answering the following two questions. Let's start with the environmental analysis. From a political and social perspective, there was a resistance towards foreign takeovers in Germany. Economically speaking, the telecommunications sector, however, provided immense opportunities as it was growing at 29% annually. Looking at it from a technological viewpoint, there was substantial growth potential due to the new 3G technology. Legally, however, it was slightly more difficult as there was a 75% shareholder approval requirement from Mannesmann. Conducting parts of three tests, we can see that two out of the three tests have been passed as there are significant benefits but also extremely high entry costs.
In November 1999, Vodafone offered to acquire Mannesmann for $243 per share, which was rejected. A second offer at $276 was also declined. By February 2000, Vodafone valuation reached $350 billion, the largest M&A deal in history. Mannesmann accepted, with shareholders receiving 49.5% of the new company. Vodafone raised $30 billion in loans to finance the deal. By April, the European Commission cleared the acquisition, finalizing the merger. Vodafone's strategy led to strong customer growth and data revenue expansion through new services. Mannesmann key assets like Mannesmann Arcor with 2.2 million customers and Segatel with 15% of the market share contributed significantly. Post-acquisition, Vodafone saw a 29% increase in turnover and a 56% more registered customers. However, challenges emerged with the shift from industrial to telecom services and cultural differences, which Vodafone addressed by adopting German industrial relation practices.
During the Vodafone and Mannesmann acquisition, Vodafone had three main options. First, they could focus on organic growth by using their own resources to expand, especially the 3G technology. Second, they could go in for a partial acquisition, keeping Mannesmann's telecom assets and selling off any non-core businesses. Lastly, they could pursue partnerships with Mannesmann to grow together the 3G network, reducing conflicts on the way. However, the implementation was not without challenges. Vodafone's hostile approach generated friction, making joint ventures or partnerships a missed opportunity to reduce resistance from Mannesmann's stakeholders. Furthermore, stronger valuation justifications were needed to secure shareholder buy-in, and a more creative bid structure could have mitigated shareholder concerns over the undervaluation risks. By looking through the McKinsey 7S framework, Vodafone's best bet is to align their mobile and telecom services for a full-service solution, focus on innovation, and create unified platforms. Cross-training teams and building strong leadership would ensure long-term growth and success.
Vodafone's revenue increased by 4 million by 1999 due to subscriber expansion in Europe and the acquisition of AirTouch Communications, boosting its global market share. EBITDA steadily rose from 1.53 billion in 1995 to 4.29 billion euros, supported by improved margins and economies of scale from the Mannesmann acquisition. We analyze the financial data from the following tables. From the results, we had significant growth due to horizontal integration. Revenue had declined around 11 billion due to market saturation and competitive pressures from participating in a red ocean strategy. However, profitability remains strong, with EBITDA using portfolio management as a diversification strategy, effectively contracting the winner's curse.
Here we present Vodafone's cumulative return around the merger. With the announcement date as date zero, the table shows a significant stock decline in both 3-day and 5-day windows, reflecting that the market believed Mannesmann was overpaid. In addition, the bottom table highlights Vodafone's long-term struggle with the winner's curse. Before the merger, Vodafone had a strong return of 88% in 1999. But post-merger, its stock fell by 44% in 2001 and continued to underperform in the following years, while the S&P 500 performed much better during the same period. The market usually tells the truth. Actually, the market value of Mannesmann was $163 billion right before the announcement date, but Vodafone paid $190 billion, adding a 27 billion premium, which is huge. In fact, by 2006, Vodafone recorded a goodwill impairment of over 20 billion pounds related to this merger, further showing that the premium was not justified. Combined with Vodafone's stock underperformance in the following few years, it is hard to say that the financial outcome have met the expectation.
It's hard to justify the high premium because financially there were negative stock returns as well as capital allocation issues which led to worsened liquidity. Operationally, there were significant cultural resistances as well. However, the strategy as a whole could still be considered to be viable for Vodafone because the telecommunication industry is an ever-evolving one, evident by the emergence of 3G, 4G, and 5G just within 2 decades. If Vodafone does not maintain its market power, it will be easily replaced within this industry by its major competitors such as BT and Dish Telecom. While it might be a costly move, you could say it was necessary for Vodafone to maintain its position as a market leader. Just to go through everything we've done, in terms of the decision quality, despite its high entry cost, 2 out of the 3 Porters tests have been passed, and the merger is still considered incredibly attractive. A major point which affects the decision quality, though, was that there was a significant political resistance in Germany about the hostile takeover. Now, for the implementation, we assessed the alternative strategies as well as the implementation success using the McKinsey 7S framework, and for the outcome, in the short run, it's hard to justify the premium financially, but in the long run, the strategy had brought a good outcome to Vodafone, who is in talks for another acquisition with 3 UK.